what are some of the then most, I guess, interesting or out there things you've seen people invest in? I didn't know the list was that long. I thought you were going to rattle off like, here are the 5 things. Not you could invest in anything.
Well, I can't answer your question and tell you what are the most common things. So real estate, just as a general asset class, but you can do real estate where, you're buying an apartment and someone is paying you rent each month into your IRA account. That's common. The deals like you guys do where you're syndicating deals or you're pooling money together where your IRA might be a limited partner in a bigger project. Those are common. Lending where you're being a bank and loaning out of your IRA account and the borrower is paying into your IRA. Private placements, which is anything that's privately offered, things like, private equity, cryptocurrencies, futures and Forex trading, gold, precious metals, commodities. All of those things are the most common things that we see. Some of the more off the wall ones that we've seen and through an LLC, we've seen folks invest passively into racehorses, movies. Here locally in Chicago, I had coffee at a place this morning that is passively invested into through an IRA account. I had lunch on Monday at a restaurant where someone passively invested into with their IRA. You and I laughed that we're both oddly wearing the same type of brand of shoe, which we have clients invested into early on with this shoe company. So all sorts of things people have invested into.
That's interesting. That we're wearing the same shoes. I'm not surprised, but these are very versatile.
Yeah.
So that's, but I guess we shouldn't give away the name now, but that's interesting. Cause I just always think of everything in like let's say a real estate context, but there's been a lot of, you hear these rumors of people making investments and things and, like the Yelp founder, he like famously whatever units he bought at the start of the company, he put in his Roth IRA. And I'm sure you've heard stories like that. So he basically owns his whole thing, just with no tax whenever he decides to hit the sell button. So
I mean, what these accounts allow for someone to do is to truly diversify, but also seize on an opportunity that you believe in. So I don't think everyone is cut out to be an expert in the stock market, or they want to invest into a Fortune 500 company. You might meet a buddy or a friend or hear of an idea locally that you say to yourself, man, I want to get in early on that, or I just believe in that. I just feel more comfortable in driving by and seeing where my money is invested into versus, whatever the winds of the market are going to do that day. And that's what these accounts allow for. So the variable obviously is the investment. If you invest into a company like Yelp early on, you stand to make a lot of money. But even investing locally into, we have folks that have invested into farms that provide organic food for people, and they do that more as like a passion project than to chase returns. These accounts just allow you, the end user, the investor, to choose individually what they want to invest into.
Yeah, and I mean it's great diversification too.
Yeah.
Where you're just otherwise you have all your money tied up in stocks and bonds. And this opens up the realm of what you can invest in big time. It's
true diversification, we always say, is rather than investing into real estate in a REIT, that's still tied to the market in many ways. You can own a building that you can drive by, so it's pretty cool.
Right. And so what are the different ways people could invest in real estate, let's say, because there's within their retirement account?
Yeah. So for a little bit of context, the IRA accounts, there's a general average like account size of just above $100,000. So when you talk about buying a home or that you're going to rent, or an apartment that you're going to rent, that really does kind of limit what you're able to invest into. So
and that's just like the average of like all IRAs?
All IRAs, yeah. If you include 401ks in there, it might be a little bit higher, but just IRAs. And a lot of that is based on, remember, the contribution limit being so low. And if you didn't start when you're 17 like you did, or 16, but there's a lot of catching up to do.
just checking, because that just puts it in context. I didn't know if that was a Midland thing or what. That's just all IRAs nationwide.
All
That's
IRAs. It's in that ballpark. It might not be exact, but it's in that ballpark. But so the most common way that people invest into real estate is through partnerships, like through an LLC, where someone can invest $10, $15, $25,000 into a project, and they might be able to invest into multiple different projects at once. Again, more diversification, the better. Or to invest into a fund that's doing different projects. So that's the most common way that we see people invest into real estate, I'd say.
And then what are I'd like to get into, I guess, all the ways, because I know there's a lot of like things to work around if you start doing want to invest in real estate different than that. Because for me personally, what I have found, and you can just add color as we go, but normally like all the deals I do, I'm the sponsor, so I'm on the loan. If there's a carve out guarantee, which means the loan's non-recourse, but if some sort of act's done, like you commit fraud or don't you don't use the rents to pay the mortgage or misappropriated insurance proceeds, like then it becomes a recourse loan. So like I'm on those kind of carve outs, or a number of our loans are just full recourse to begin with to me individually, where if there's any non-repayment of interest or principal, then it's recourse to me personally. And I'm also the decision maker on the entity buying it. I'm the manager. And so what I had learned with investing in retirement accounts is you can't be on the loan in any capacity individually, even on non-recourse carve-outs. So that limits a bit what you could do. So then what was the easiest for me is I had a friend who went to UW-Madison with me, and he was doing some really nice deals around Chicago and taking dollar amounts that like I had, where not every real estate sponsor is going to take $15,000 from someone. They might have $100,000 minimum, which then, to your point, that could be someone's entire retirement account, which and that's not smart either. Put all your money in one deal. So then, and definitely not if it's still your your retirement account. So that so I have but I know people, they are able to work around that. Obviously the easiest way would be you buy a property all cash. Now there's no debt involved. How would someone, if they wanted to buy a property on their own in their retirement account, do it?
So the thing that you touched on that makes it difficult and is often confused in our industry is that, all right, great, I got $50,000 in my IRA account. I'm going to put 20% down, and then I'll leverage the rest. Unfortunately, there's a IRS restriction that doesn't allow one of those disqualified persons, which is the account holder in this case, to sign a personal guarantee on a loan. So it has to be a specialized loan, that's a non-recourse loan, to where it's the IRA that's taking on the debt, and then the rents that accumulate off of that property are used to pay for it. And the lending criteria can be pretty stringent, and not as 20% down and everything will take care of its own. So it really limits. Most of the properties that I've experienced in my 12 years at Midland have all been cash deals, whether it's cash deal where I have all of the money in my IRA account. So I'm buying a property that's $200,000, but I have enough to cover that. Or it's cash deals in that, like, you and I can go together and you can use an IRA and I can use cash, and together we're buying this property cash. Those are the most common ways that we see it. And then one of the things too, just administratively keep in mind, when you own real estate inside your IRA account, any expenses related to that property and any proceeds for the investment have to come in and out of the IRA account. So when that tax bill comes due, it's actually your administrator that pays that out of your account balance versus you stroking the check from your personal account.
Right. And which tax bill are you talking about?
Property taxes, I should say. Yeah.
Just checking. Because thanks for joining us on the Rise and Invest podcast. Please be sure to hit that subscribe button on YouTube or wherever you enjoy your podcasts. If you'd like to dive even deeper into real estate investing, check out our company's website, riseinvest.com. If you are an accredited investor, you can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Breneman and guests as of the date of recording and do not purport to reflect the views or opinions of Rise Invest Holdings LLC and its subsidiaries. The views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities, and the speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.